Welcome to Talk Tickers. Today we're diving straight into the latest earnings call for LPL Financial Holdings Inc.
That's right.
We're here to give you the essential insights, basically cut through the noise.
Exactly. We'll hit the highlights first, the main numbers.
And then we'll really get into the weeds, explore what's driving things for LPL and, what it might mean for investors.
Sounds good. So LPL kicked off 2025 looking pretty strong.
Yeah, what stood out?
Well, total assets hit a new quarterly high. We're talking $1.88 trillion.
Wow, okay. Trillion with a T.
And they pulled in a record $71 billion in organic net new assets just in the quarter.
$71 billion in 3 months.
Yep. That's about a 16% annualized growth rate. Yeah. Which is pretty significant.
That's huge. And earnings.
Also a record. Adjusted EPS came in at $5.15.
Okay.
And of course, the elephant in the room, it's a big announcement.
It's Commonwealth Financial Network deal.
Exactly. A major agreement to acquire them, really aimed at accelerating LPL's goal to be, the top wealth management firm out there.
Right. So despite any market choppiness, they seem pretty happy.
They describe the overall business performance as excellent. So, yeah, quite positive.
Okay. $71 billion organic growth. That's impressive. What's the engine behind that? What are they doing right?
It seems like a few key things working together. They talk about pursuing differentiated strategies. Meaning they're trying to offer something unique, not just be another platform. Plus, a big focus on their own employees' experience.
Happy employees, happy advisors, maybe.
That seems to be the idea. And underpinning it all is this push for operational excellence, making things smooth, efficient.
Right. So good tech, good service.
Exactly. That whole package seems to be really attracting advisors and keeping the ones they have. Their retention rate is still industry leading, around 98%.
98% is sticky.
Very. And it attracts new assets, too. Recruited assets in Q1 alone were $39 billion.
$39 billion.
Yeah, bringing the total for the last 12 months to a record $167 billion.
Okay, where are these assets coming from mainly?
Well, their traditional independent market had a record first quarter, pulling in $20 billion. Their newer affiliation models like Strategic Wealth, the independent employee model, their enhanced RIA offering, they added about $2 billion combined.
Okay.
And the traditional bank and credit union channel brought in about $1 billion. So broad-based strength, really.
And they've been busy onboarding too, right? Besides planning for Commonwealth.
Oh, yeah. They finished bringing WinTrust Financial's retail wealth business over.
Right.
And also completed the transition for Credential advisors onto their platform. That was a big one.
How big?
Those two alone added over $80 billion in client assets just in Q1.
$80 billion, wow.
And they also closed and onboarded the investment center. Plus, the integration of Atria Wealth Solutions is still ongoing.
And First Horizon is coming up?
Scheduled for Q2, yes.
Oh.
So lots of moving parts on the integration front.
Which brings us back to Commonwealth. That's the mega deal. What's the strategy there? Really boil it down.
It's about scale and leadership. Plain and simple. They want to be number one.
And Commonwealth gets them a big chunk closer.
A huge chunk. Potentially $350 billion in client assets once it closes, expected later this year. It cements their position, expands their reach, especially in that independent channel.
But integrating something that size, it's got risks, right? How are they approaching it?
Very carefully, according to the call. The message was all about preserving the Commonwealth service experience and culture.
So not just swallowing them whole.
No, the idea is to enhance it, bring LPL's tech, their platform, research, resources, but keep what makes Commonwealth advisors loyal.
And how's that being received?
They said early feedback from Commonwealth advisors is positive and retention efforts are tracking to plan. So cautious optimism, it seems.
Okay, so that's the growth story, organic plus M&A. How does this translate into the financials we saw in Q1?
Well, like we said, total assets hit $1.8 trillion, up 3% from Q4. And even if you strip out those big onboardings like WinTrust and Credential, the underlying organic growth was still around 7% annualized.
Still very healthy.
Definitely. And profitability looks good too. Adjusted pre-tax margin hit about 40%.
40%, okay. Let's dig into the revenue lens a bit.
Sure. Gross profit was $1.273 billion, up from Q4.
Okay.
Commission and advisory fees, net of the payout to advisors, came in at $363 million, also up.
What about that payout rate? You mentioned it might change.
Yeah, it was 86.8% in Q1. They expect it to tick up a bit in Q2. That's pretty typical, related to how some compensation plans work seasonally.
Got it. And client cash, always an interesting area.
Client cash revenue was $408 million, up slightly. Balances ended Q1 at $53 billion.
And the yield they earn on that?
The ICA yield was 3.37%. They expect that to be roughly flat in Q2.
Okay. Any other revenue lines to note?
Service and fee revenue was $145 million, expected to grow sequentially in Q2. Transaction revenue was $68 million, expected to be about flat.
All right, so revenue looks solid. Let's flip to the expense side. With all this activity, how are they managing costs?
Actually, they seem pretty focused on efficiency. They lowered their full-year outlook for core G&A expenses.
Lowered it, despite the growth.
Yep. The new range is $1.730 billion to $1.765 billion. For Q2 specifically, they're guiding to $435 to $445 million in core G&A.
Where are expenses expected to increase then?
Promotional expenses are expected to go up in Q2. Think conference season plus transition assistance for recruiting.
Makes sense.
And interest expense is the big one to watch. It was $81 million in Q1.
Okay.
That's expected to jump significantly in Q2 because they issued new debt, those senior notes, to fund the Commonwealth deal.
Right, financing the acquisition.
Exactly. But on the flip side, they'll also earn more interest income in Q2 on the capital they raised before deploying it.
Okay, balancing out somewhat. How does this all impact their capital position and leverage?
They ended Q1 with $621 million in corporate cash. The leverage ratio was 1.8 times.
Pretty moderate.
It is, but it's expected to go up to around 2.25 times once the Commonwealth acquisition closes.
That's a notable jump.
It is. And because of that, they've paused their share buybacks for now. They did buy back $100 million in shares in Q1, though.
And the plan post-closing?
The plan is to prioritize deleveraging, paying down that debt, alongside organic growth and, future M&A down the road.
Okay. Let's talk about the advisors themselves. Recruiting and retention are so key. What's the vibe in the market?
LPL seems to think advisor movement is kind of settling into a new normal, maybe around 5% of advisors moving firms each year.
And they feel good about capturing their share.
They express confidence, yeah. They believe their platform, tech, service, the whole package gives them an edge in attracting advisors who are looking to make a change.
Even with market volatility, does that slow things down?
It can sometimes cause advisors to pause. Yeah, just wait and see. But LPL said their overall recruiting pipeline remains strong.
Okay. What about activity from existing clients and advisors? Any trends there?
Yeah, they mentioned focusing on same-store sales, helping their current advisors grow their own practices.
Makes sense. Grow from within.
Right.
Yeah.
And they also noted that sometimes when markets get choppy, clients tend to lean more on their advisors' sort of flight to quality.
It's interesting. How did cash balances look more recently, like in April?
April saw the usual seasonal outflows, tax payments, advisory fees hitting. So overall cash balances dipped slightly to $51.8 billion.
But underlying flow.
They said the underlying organic growth in cash was still strong. Factoring out seasonality and some known large departures they'd flagged previously, April's organic asset growth was around 4% annualized. Assets ended April still around $1.8 trillion.
Okay. Let's circle back to those integrations. Atria, Credential, how are those progressing?
Atria seems on track. They're still aiming for about 80% asset retention and the $150 million run rate EBITDA benefit by the end of the year. The actual advisor conversions have started and are going well, apparently.
Good news there. And Credential.
Credential onboarding is actually complete now, and it came in better than expected.
Oh, really? How so?
They brought over $67 billion in assets, which was higher than the initial forecast.
Nice beat.
Yeah, and because of that, the expected run rate EBITDA contribution from Credential has been increased to $80 million. One thing to note there is the cash from Credential clients is expected to gradually shift into LPL's main cash program over the rest of the year.
Got it. Shifting gears a bit, what about their institutional business? That's been a big growth area.
Absolutely. They've really carved out a leading spot in the large bank market. They've attracted about $120 billion in assets there so far.
And the potential?
They estimate the total market opportunity in large banks is around $1.5 trillion. So still plenty of runway.
Oh.
And they're also looking at expanding into the insurance broker-dealer and product manufacturer space. That's potentially another $1.5 trillion opportunity.
But with Atria and Commonwealth integrations needing focus.
Exactly. They basically signaled that while the opportunity is there, don't expect more major institutional announcements in the very near term. Focus is on execution right now.
Understandable. Thinking about Commonwealth again, how does LPL view the competitive landscape for those advisors? Are other firms trying to poach them?
LPL seems pretty confident. They suggested there aren't many credible alternatives. for Commonwealth advisors that can offer the same combination, preserving the Commonwealth feel while adding LPL's scale and capabilities.
Kind of a unique pitch.
They think so. And generally, they see the wealth management space consolidating. Smaller firms might find it harder and harder to compete against the scale of players like LPL.
Makes sense. Do they have the capacity to handle all this onboarding, Atria, Commonwealth, plus regular recruiting?
They stated they've built significant capacity for these large deals. But again, the near-term bandwidth will be pretty consumed by Atria and especially Commonwealth.
One last specific. The annuity sales seem strong. What's driving that?
Yeah, they acknowledge strong annuity sales. A good chunk of the recent growth was attributed to bringing Credential fully on board, as annuities are a bigger part of that business mix.
Okay. So mix shift effect.
Partly. The rest reflects their core business trends and just the current market environment, demand for income products. They did hint that annuity commissions might moderate a bit if interest rates stabilize and volatility calms down.
Interesting. Okay, so a lot going on. Strong organic growth, major acquisitions underway, particularly Commonwealth, focus on integration, managing expenses, and leverage. It's a busy time for LPL.
Definitely. The next few quarters are crucial for integrating Atria and especially Commonwealth successfully. Execution is key.
All right, let's pivot to our final segment. And remember, this is absolutely not financial advice, just a speculative thought experiment.
Lay it on us. Purely hypothetical, of course.
Okay. So LPL is taking on significant leverage and integration risk with Commonwealth, right?
They are. Around 2.25x leverage post-closing is the expectation.
So here's a wild idea, a pairs trade. Maybe you go long the corporate bonds of a, let's say, similarly rated wealth manager, maybe one known for steady organic growth, but less M&A appetite.
Okay. Long a steadier peer's debt.
Right. And then you short LPL financial bonds with a roughly similar maturity.
Short LPL debt. What's the thesis?
The idea, purely speculative, is that the market might get nervous about LPL's integration execution or the higher debt load. If they stumble, or even if perception just sours temporarily, LPL's bonds might underperform the bonds of that safer peer.
So you're betting on potential integration hiccups or just market jitters about the increased leverage impacting LPL's debt relative to a peer.
Exactly. It's a high-risk idea, hinges totally on execution and market sentiment, could go completely the other way if the integration is flawless and synergies come through fast.
Definitely high risk.
And?
It needs way more research than just this chat.
Absolutely. Not financial advice, just food for thought based on the dynamics discussed. Always, always do your own deep homework.
Right. So that wraps up our deep dive into the LPL Financial earnings call. We've hit the key numbers, the strategy, the big Commonwealth deal, and the outlook.
Hopefully this gives you a much clearer picture of what's happening at LPL and the factors to keep an eye on.
What do you think about the Commonwealth acquisition? Is it the right move? How do you see things shaking out in wealth management? We'd love to hear your thoughts.
Remember, this was just our breakdown of public information, definitely not investment advice. Thanks for tuning in to Talk Tickers.
We'll be back soon with another earnings deep dive.